All right, let's just dive right into this explainer. Most of us picture getting a real estate loan the exact same way, no matter what is actually being bought. You walk into a bank, they look at your paycheck, they pull your credit score, and eventually they hand you a 30-year mortgage. And that is exactly how it works when you buy a house. But what if you're buying a warehouse? Today, we're going to shatter a core assumption about how real estate financing actually operates. So, do all mortgages work alike? Short answer, absolutely not. There is this massive myth that getting a loan for a business property works just like getting that 30-year home mortgage. But the truth is, the moment the property you're buying is intended for business or investment income, almost none of that standard home buying process is true anymore. A completely different set of rules takes over.
See, with a standard home loan, the bank is staring squarely at your personal paycheck. But a commercial loan, the lender honestly barely cares what you personally earn. They are obsessed with the business income. Let's dig into how this builds, because first, we need to draw a clear line in the sand.
Section 1. Defining the commercial loan. So, what exactly are we talking about here? A commercial loan is secured by a property that's used specifically for business or to generate income. We're talking office buildings, retail centers, warehouses, and hotels. And notice that last bullet point, apartment buildings. A residential mortgage is for a home people actually live in, usually a single-family house or a building with up to 4 units. But the second that apartment building hits 5 or more units, bam, it crosses the threshold into commercial territory. Plus, the borrower on a commercial loan is often a business entity, like an LLC or corporation, rather than just an individual signing in their own personal name. Sure, they're both technically mortgages because a property secures the debt, but honestly, that's where the similarities end.
Section 2. The core mechanical difference.
Here is the massive paradigm shift. A residential lender evaluates the person. They want to see your income, your credit score, and your debt-to-income ratio. They are betting on you. A commercial lender, on the other hand, looks at the property. They want to know if the rent it brings in is actually enough to cover its own loan payment. They're betting on the deal.
I absolutely love this quote from our source material because it instantly clarifies the mechanics here. Quote, "It's the difference between lending to a person and lending to a business plan that happens to be made of bricks." Think about that for a second. When you buy a house, the bank is lending to you. When you buy a commercial building, the bank is literally lending to a business plan.
So how on earth do lenders actually measure a business plan? Well, they use something called the Debt Service Coverage Ratio, or DSCR for short. DSCR is the property's net operating income, meaning its profit after expenses, divided by its annual loan payments. In plain English, this is the absolute core math that drives commercial loan approvals. It simply measures whether the building's own income is large enough to pay its own mortgage.
And lenders usually have a magic number in mind. Typically, they want to see a DSCR of roughly 1.20 to 1.35. In fact, widely used programs from Fannie Mae and Freddie Mac generally require at least a 1.25. What does that 1.25 mean? It means the property brings in 25% more income than it actually needs just to cover the loan. It's basically a built-in safety cushion for the bank.
Section 3. Why it works this way.
Now, you can really see how differently lenders price risk here. Because a commercial loan depends entirely on a business succeeding, lenders generally treat them as riskier. So while you might get a residential loan with as little as 3 to 5% down, which is barely enough to buy a used car sometimes, commercial loans commonly demand huge down payments, usually right around the 20 to 30% range. You also see completely different rules regarding consumer protection and term length, which we'll break down right now.
For instance, federal consumer protection laws like the Truth in Lending Act, or TILA, and the Real Estate Settlement Procedures Act, RESPA, were literally built to protect individual people buying a home. But these laws specifically carve out loans made primarily for a business or commercial purpose. So all those strict disclosure timelines and safeguards for home buyers, they generally don't apply here. Though it is important to point out that some laws, like anti-discrimination rules, definitely still remain in effect.
The term lengths are totally vastly different too. You're almost never going to find that cozy, fully paid off, same payment for 30 years structure in commercial lending. These loans are often sourced from community banks or specialized lenders, and they generally run much shorter. We're talking 5 to 10 years, and they frequently feature a massive balloon payment, where the rest of the balance is suddenly due all at once.
Section 4. What can go wrong? Because the whole approval rests on the property's income, a commercial loan is incredibly exposed to anything that messes with that cash flow. An anchor tenant packs up and leaves, the local market takes a sudden downturn, vacancy rates start climbing,
All of that immediately weakens the original DSCR math the lender relied on. The bricks might be totally solid, but if the business plan fails, the loan is in serious trouble.
Which brings us to personal liability, and this varies wildly on the commercial side. If a foreclosure doesn't actually cover the debt, who pays? Well, commercial loans range from fully recourse, meaning the borrower is personally on the hook to make up the difference, to non-recourse, where the lender can strictly only take the property itself. Where a loan lands between those two extremes just depends on the specific property, the lender, and how financially strong the borrower is.
Also, because the borrower is usually a business entity, evaluating its credit and track record is way more involved than just pulling one person's credit report. This is exactly why getting a commercial loan feels like such a heavy lift. It is a much longer, incredibly document-heavy process compared to your standard home mortgage.
Section 5. The bottom line. Let's bring it all together. A residential mortgage is approved based on the person buying the home, your income, your credit, and your ability to make a fixed payment. A commercial loan is approved based on the property itself and its ability to cover the debt using its own income. One isn't necessarily better or worse than the other. They just rely on completely different math, different regulations, and different term structures simply because a paycheck and a rent roll are fundamentally different things to lend against.
I want to leave you with this final thought as we wrap up this explainer. If a local business closes its doors, how does that actually impact the physical building it sits in? Once you grasp the concept of DSCR, you realize commercial real estate isn't just about owning physical space. The value and the safety of that building are mathematically tied directly to the success of the local businesses operating inside it. Kind of changes how you look at the world, right? Keep that in mind the next time you walk past your local shopping center.